Thank you, Sanjay, and thank you to GTR. It's a pleasure to be here today, speaking to you all, representing the views of Capital Economics. We're an economic and geopolitical consultancy based in London. As Sanjay has said, there's lots of really terrific speakers and sessions lined up for today, but really I think my job as the keynote speaker is to just take a step back and help to sort of set the scene on the sort of future of world trade from the global kind of macro perspective. I mean, it's really clear for everyone that we're trying to navigate our way through an era which is going to be marked by rising sort of geopolitical tensions, higher economic uncertainty, and by extension, the landscape of global trade is undergoing some pretty profound transformations. So with that in mind, I wanted to try and sort of unpack three sort of topics in the next sort of 10 to 15 minutes or so. So first, I was going to look at President Trump's tariff policies. So you can wish me luck on that. Assessing at how they might affect trade flows in the near term. In the second, I'll consider global trade beyond the Trump era. So in particular, through the lens of geopolitical blocs, one that is led by the US, one that is led by China. And within that, we'll discuss some of the potential beneficiaries of supply chain reorientation. And in my third section, I wanted to discuss the future of the US dollar and whether some recent talk of its sort of long-term demise is exaggerated or if it's inevitable as the global economy starts to splinter. But let's start with the current state of play. Now, of course, there's a massive amount of uncertainty around Trump's trade policy, particularly since the so-called Liberation Day tariff announcements and then the subsequent rolling back in tariffs since then. But I do think that there are some lessons that we can now start to sort of take forward. It's clear, I think, that the Trump administration is in the mood to make deals. Trade deals in particular. And for countries that are able to secure trade deals with the US, it's likely that at the end of this 90-day reprieve, we're now 35 days into it, that they will face lower reciprocal tariffs than countries that aren't able to make deals. But on top of that, it does also look like a universal or a baseline 10% tariff is going to be here to stay, and that's probably non-negotiable. That's certainly the case with the UK, for example, which announced its trade deal with the US last week. And the third sort of key assumption is what happens to China. And really, I think it's likely that the administration will keep a higher tariff on China than it will on the rest of the world, even if that China-specific tariff looks like it's going to be lower now than may have been the case a week or so ago. So you can see in this chart that the effective tariff that the US has put on China after the trade talks at the weekend is still at around 40%. So it's much higher than everywhere else in the world. And there's no real guarantee that that 90-day truce between the US and China is going to last anyway, especially because the US is still pressuring other countries to impose their own restrictions on trade with China. So what does all of this mean for global trade? Well, the starting point is important here. If we go back to just the eve of the trade war, so at the beginning of this year, global goods trade was at its highest on record. So in history, it has never been higher than where it is now. Now, of course, the US turning more protectionist, but also just general uncertainty in the global economy, given the tariffs, isn't going to be helpful for global trade. But at the same time, I think it's very unlikely that we see a complete collapse in global trade as a result of these policies. You can see on this chart, for example, that global trade tends to be very resilient. It bounced back extremely quickly after the start of the pandemic. It took a bit longer, but it did recover gradually after the global financial crisis as well. So I think we're looking at something like a softening in trade volumes over the next couple of years, perhaps by 1 or 2%. Given lower imports to the US. But overall, it's very unlikely that global trade collapses from here. What I think is actually more important is not so much the volume of global trade, but more about the pattern of global trade. And I think there we'll see some more profound shifts. Of course, China's exports to the US are going to be weaker, and there'll be other countries that steps up to replace that. And to assess, or to at least have a stab at assessing which countries are well placed to do so in the near term. So I'm talking before we think about supply chain reconfiguration, we can look at the similarity in exports between China and other countries. So this is an export similarity index. Essentially, this captures how replicable a country's exports are to those of China. So countries with a higher bar have more similarity in their exports to the US as China does. And the short point from this chart really is that the likes of Vietnam, Thailand, Mexico, but also India are pretty well placed in the near term, so the next 1 or 2 years at least, to capture some of that market share from China. Of course, this is a slightly oversimplistic picture. It's going to depend on many things, whether a country can step up to the void, to fill China's void. That includes the degree of spare capacity in the economy. It includes things like consumer preferences. But it does help to illustrate at least where there may be existing equipment and expertise in order to step in to fill China's shoes. Now, the other point I think to consider is what is going to happen to those goods from China that would have otherwise gone to the US. And it's worth noting that exports from China are extremely competitive. I'm sure there's many of you in the room that can attest to that. So what this chart shows is that over the past sort of couple of years, China's export prices indexed have fallen by around 20% or so, whereas in the rest of the world, export prices have remained largely stable. And what this means is that having already been extremely competitive, China has actually been able to gain or maintain its market share despite having less access to the US. And just to really hone in on that point, this chart shows just one industry. It shows the global share of clothing and textiles exports from last year. And I mean, I think the point really is quite obvious. China completely dominates this market. It controls about 1/3 of global textiles exports. That share hasn't really shifted. In fact, it's risen over the past few years because China's exports have become more competitive. And then if you look further down the list, you can see the likes of India, but as well as Bangladesh and Indonesia, who are often considered as competitors to China, having their market share remaining at around 5% or so. And what I think this might do is lead to a pushback against another big rise in imports from China. So the countries that are most likely to respond, I think, to another wave of cheap Chinese imports are those with manufacturing ambitions of their own, or countries that aren't especially dependent on China either for investment or for trade. So again, this includes India, but I also think it includes parts of the Eastern Europe, Mexico, but also some advanced economies such as the EU and Japan as well. Now, I think if we were to see some response to a flood of Chinese imports, it's more likely to take the form of specific product level tariffs rather than an across-the-board tariff like we've seen in the US. So countries will try to stick to rules according to the WTO and impose those tariffs using anti-dumping rationale. But either way, I think the point is that if we do see higher restrictions on Chinese imports, then that does open the door for exports from other countries to grow. Now, as promised, the second part of my talk is going to be on the global trade landscape post the Trump era. After all, as important as Mr. Trump undoubtedly is, there is a tendency to sort of overstate that, I think. The trend of US and China decoupling or fracturing is something that precedes both of his presidential terms, and it's something that we think is going to be continuing beyond the next sort of 4 years. And it's important to understand what we mean by fracturing. And what that is so after a period of very intense globalization, the global economy is now splitting into competing blocks with countries coalescing around the superpower nations that are vying for geopolitical influence and power, and those are the US and China. The economic relations within those blocks then start to fray or break apart, and that can happen along several lines, including trade, investment, and financial flows. And what this map does is help to give a sense of how we think that each economy is aligning through this geopolitical lens. So countries in grey on this chart are those that we think are non-aligned, so they're keeping relations largely equal between the US bloc and the China bloc. The countries in red, or different shades of red, are aligning with China. You can see that includes Russia, most of Africa, and also parts of Latin America as well. So typically the commodity producers. And countries that are shaded in blue are those that are aligning with the US bloc. That includes Europe, that includes Australia, Japan, but also India as well. And if we view global trade through this lens, then the really important question, I think, is what part of world trade is going to be affected by fracturing? This is obviously a very difficult question to answer because we don't know the exact form that fracturing is going to take or how severe or how deep it might become over the coming years. But we should still at least give it a go. And this chart attempts to do that. So you can see here, and I'll talk you through it, but around 75% of global trade, goods trade, takes place between some of the blocks that I laid out in the previous map. So the US bloc is shown in blue, and you can see that that accounts for about 50% of global goods trade as it stands. The line at the bottom is the China bloc, and that accounts for another 10% of global goods trade. And in the grey line, that is trade with some of the non-aligned countries, and that's another 15% or so. Now, some trade between the US and its allies, including Mexico and Europe, is obviously going to be affected by higher tariffs during the second Trump administration. But the more important point, I think, over the long run is that the fundamental drivers of this process of geopolitical fracturing mean that the focus is going to fall primarily on the 25% of global trade that takes place in between blocks, which is shown in the purple line. And I think it's there that we are going to see the more profound shifts in trade flows. Now, I'm not suggesting by any means that we're going to see a complete breaking up of that purple line and no trade at all happens between the blocks. That's a very, very extreme form of fracturing. I don't think it's going to be anything like that. But it is within that line, so that purple line, that we think that most trade flows are going to be affected. So with this framework in mind, it opens up opportunities, I think, for other countries to benefit from the reconfiguration of supply chains. I'm not going to spend too long talking about this because I know that there's some dedicated sessions that are going to delve into this later on. But just a few points I think worth mentioning. Firstly is that I think India looks extremely well positioned to benefit from these shifts. It has a pretty strong, warm relations with the US. India is the only country globally that can match China in terms of the size of its workforce. There's obviously a very big domestic market, and that helps to hedge against tariffs if you are a manufacturer looking to relocate. And there's also been very positive progress on economic reforms over recent years, which is something that Sanjay alluded to. And that includes liberalizing trade policy, not only with the US, but with other countries as well. There was the UK India trade deal announced last week, for example, after 3 years of talks. So it does seem that we are now getting breakthroughs when it comes to liberalizing trade policy. There are obviously there are obviously challenges to be overcome. We're going to hear about plenty of those over the rest of the day. But fundamentally, I think that there's a bullish case for supply chain reorientation into India from the macro perspective. Now, beyond India, A few other countries worth mentioning that could be benefiting from this shift. One really obvious one, I think, is Vietnam. Really, it was the big winner from the first trade war, and the advantages that it had then are still in play now. So it's got the proximity to Chinese supply chains, it's got very low labor costs. Other countries that stand out as well are Indonesia and the Philippines, I think. Both have very good demographics, much like India does. Perhaps a slight disadvantage in both of those cases, though, is some backsliding on pro-business friendly reforms over recent years. I also think that there's a case to be made for Malaysia, which has a very highly skilled workforce and relative political stability. Although higher wages there means that it's probably not going to be able to compete at the very sort of low-cost, labor-intensive end of manufacturing, but it is well positioned, I think, to capture some of the higher-end value added in manufacturing. And then if we look beyond just Asia, the other obvious place that I think stands out is Mexico. It's got proximity to US supply chains. Again, it's got pretty low labor costs and an existing manufacturing base. But its disadvantage at the moment is that it is trying to navigate a pretty difficult relationship with Mr. Trump. So the short point being is that there aren't any sort of clear winners necessarily, but instead a number of countries that could all offer some strengths when it comes to potential supply chain reorientation. Now, in the final part of my talk, I wanted to touch briefly on an emerging topic of discussion, which is the role of the US dollar in global finance and in global trade. The speculation around the currency's global status has been triggered by the really big sell-off that we've seen in dollar assets over the past few months. That's, of course, been driven by concerns around the damage to the US caused by Trump's tariff policies, but also its chaotic implementation as well. But for all the noise that we've heard coming out of the discourse, the drop in the dollar this year is only taking it back to the level that it was at last summer. And indeed, it's actually rebounded more recently anyway. And I think a lot of the recent noise around the dollar's sort of demise misses a key point, which is its primacy in global cross-border transactions. So around half of cross-border transactions take place in US dollars. That's actually far more than the US's share of global output or in global trade. So in effect, the US is, one way to think about it is that the US is providing the financial plumbing for the global economy, and that gives it a huge amount of leverage and influence. So if you think about the sanctions that have been imposed on the likes of Iran and Russia and North Korea over recent years, the US has only been able to do that because of the very unique role that the dollar plays. Now, in a way, the dollar's dominance is partly why there are hopes for it to be replaced. Years ago, the yen was seen as the challenger to the hegemony of the dollar. Then it became the euro, and more recently it's the renminbi. But none of those currencies have really been able to replace the dollar as the world's sort of reserve currency. The dollar benefits from what economists call path dependence. Now, by that I mean that it has a long history as the dominant currency. That has helped to create established norms, and it becomes self-perpetuating. So companies have become accustomed to using the dollar, and shifting to another currency now would require overcoming huge amounts of inertia and adjustment costs. Institutions and payment systems are all designed to optimize the dollar, and that makes it very convenient for users globally as well. And all of this creates a positive feedback loop, which will make the dollar very difficult to replace. Now, that's not to say that some de-dollarization won't take place. I think it will. If we go back to the geopolitical map that I outlined earlier, countries that trade within the China bloc may see some of their cross-border payments shift more into renminbi, for example. And also just the unpredictability of the Trump administration means that we could see other sharp falls in the dollar over the next few years or so. But none of this is going to replace the dollar's global influence and dominance in the global system. And that's because of these network effects, but also because there is a lack of a viable alternative. The renminbi is probably the most obvious alternative, but because of the way that the global economy is splintering, it really isn't in the interests of lots of countries, major economies, to actually switch to using other forms of payment. So I'd like to leave you with three key conclusions from my talk. The first is that Trump's tariffs are very unlikely to lead to a collapse in world trade, but instead the pattern of global trade flows is going to shift quite significantly because some economies are going to be filling the void left by China, but then also China is going to be increasing its exports to the rest of the world. The second factor is that the factors that are underpinning the fracturing of economic relations between the US and China are much bigger than just one man. And at the heart of this is a tussle for geopolitical power, which will involve several fault lines, including global trade. And at stake is around 25% of goods trade that flows between two distinct blocks, one led by the US, one led by China. And this is going to open up really big and important opportunities for the likes of India, but also parts of Southeast Asia and Mexico to capture some market share. And finally, for all the talk of the dollar's demise, we think that it's going to remain the dominant currency in global finance because of a lack of alternatives and because of very strong network effects. So thank you all for listening today. I think I've gone on for just about long enough. And I will now hand over back to Sanjay for the Q&A.
You can take your seat on the stage. Yeah. All right, so we have a quick fireside chat for about half an hour, and I would like to invite Dr. Rumki Mazumdar, Chief Economist, Deloitte. We're very lucky to have her all the way from Bangalore. Dr. Rumki, please take your seat. It's in the center. Yeah, you should be in the center. All right, so what a great data, Shailen. And a couple of statements. Probably if you are sitting here 5 years later, in one of your slides, which was slide 15, I might see rupees there. I would like to see rupees being there, if not today, right? It may be there embedded towards the end somewhere, right, within those lines that you had, but I'm sure it should come up way, way higher than even Japan at a point of time. All right, so having said that, let's first start our fireside chat, and let me roll the ball. And Dr. Rumki, we know that the tariff situation today is very fluid, and we don't know what exactly going to happen tomorrow or even after 1 week, and whenever it settles down. But what is the impact of those? And it's difficult to assess right now because of the fluidity, but there are positives and there are negatives, right? How would you assess those both?
Right. Can you hear me? All right. So undoubtedly, this has been quite an uncertain period. The last 6 months, we have seen markets roil. There's been a roller coaster ride across all sectors. We have clients running to us every now and then asking, okay, what next? It's like a soap opera. We have nail-biting moments, you have dramatic twists, and now we have a cliffhanger of 90 days. We don't know what's going to happen after 90 days, right? But all these are having an impact on markets, on investors, businesses, even consumers. In the US, consumers are holding on to many of their consumptions and are probably thinking that tough times are coming in. So this is basically a contagion effect that you're seeing not just in one country, but across the world. Now, coming to India, I would say I'll probably divide my response between trade and growth. Looking from the trade perspective, I think few positives. One is that India realizes that we have a huge reliance on certain geographies, right? And that is something which we need to diversify. And if you look at the pace at which the UK-India trade agreement happened, it's been going on for three years, and suddenly 1 month late before they reinitiated, and like last week we concluded.
Yeah, they were waiting for GTR.
Probably. So clearly there is a urgency to diversify our trade. And that helps because then it helps us reduce our exposure to certain geographies. So that's one. Second positive I would say is, come what may, there will be some realignment. There will be some supply chain changes, and I think India can benefit. This China plus one started after COVID. Many businesses started realizing that there are supply chains where what dependencies companies have, and that now has made companies realize that they need to diversify and at least reduce the exposure from certain geographies. And I think India has benefited from that, not to the extent we expected, but definitely this trend will continue. On the downside, what I believe is the costs of imports and exports will vary. Now, given the fact that we might see a lot of import tariffs coming down, so the cost prices will probably come down for us, imports. Yeah. Especially for critical minerals, and so that's good. We might even see our neighbors dumping many of their products which they cannot sell in the US. So that again might bring down costs, but it also increases competition for our own manufacturing. Because while we are trying to accelerate our efforts towards increasing self-reliance in certain critical manufacturing sector, especially like defense and EVs, if we see dumping happening in these sectors, it will definitely be a challenge. Coming to the MSME sector. Now, these are the sectors which do not have enough financial cushion to deal with these disruptions, especially in the short term and the medium term. So they might also see a bit of an impact because of the changes that we are seeing. Coming to growth, what we believe is in the next 2-3 years, we will likely see global trade coming down. It will have an impact on global economy as well. So clearly it will have an impact on Indian economy because about 19-20% of GDP comes from exports. Yeah. But that said, there are opportunities. As I said, India can quickly diversify. India can ensure that supply chain diversification that's happening, India also becomes more prominent and moves up the global value chain. And I think now it's time that India also starts realizing that it's the economies of scale that needs to come into play. We cannot just subsidize our industries and protect them. So it'll be helpful for many of these manufacturers to now look into more R&D and innovation and move up the value chain.
Yeah, perfect. Supply chain eventually comes down. It comes down to supply chain, right? At the end of the world, how do you manage your domestic as well as how do you manage your exports, and how we are able to provide the access to finance for MSMEs, which is the growth engine for us in a way. Wonderful. Let me go back to Shilan on your slide 8, right? And I saw quite a lot of textile growth that was there. Bangladesh kind of fell through the crack actually. Did kind of India pick up at that point of time in textile share, or China continues to drop their prices by 20% in their domestic manufacture and for export? And what happens if they continue to do that now, regardless of the tariff, whenever it stabilizes 90 or 100 days period? How does it matter to the global world in terms of China consistently dropping prices and kind of flooding the market with cheap product?
Yeah, so I think in many ways, when people talk about a global trade war, the risk of a global trade war comes more from a potential response to China flooding the global economy with cheap imports than it does from direct retaliation to the US, I think. So that's the first point to make. I'm not saying necessarily that we are going to get there, but I do think that that's where the bigger risk is almost. There's some really interesting points to pick out from that. I mean, when we think about textiles and clothing, it's one of the earlier stages of your manufacturing development. So essentially, China continuing to dominate that market is closing off market access and the development of those industries in some of the countries that I laid out in that chart, including somewhere like India, but also, as you mentioned, Bangladesh Indonesia, Turkey, etc.
Yeah.
And policymakers are going to be very, very wary of that. I think already there's really intense competition being faced because of cheap Chinese exports, and policymakers are going to respond. And the ones that do respond, I think, are going to be those that have manufacturing ambitions of their own, as I mentioned, but also the ones that maybe aren't especially reliant on trade for either its investment flows or trade or aid flows. Now I think India actually does fall into that category. I saw some really interesting data recently that over the past 5 years, India has about 100 or so anti-dumping complaints on China from the WTO. That's far higher than anywhere else in the world. Although there are many other countries that have anti-dumping complaints on China. So I think we're going to see a continuation of that. So India will seek to protect its domestic industry. I think the likes of Mexico, other would-be manufacturers in Eastern Europe will probably try to do the same, so then to block off access to China.
Sure.
But I think that's going to be quite targeted. I don't think that we'd see an across-the-board tariff on China from other countries, for example, in the same way that we've seen the US do to China.
Yeah.
It's more likely to be based on multilateral rules, sticking to WTO principles and targeting very specific goods that countries feel have become too cheap or that is produced unfairly in China. And I think supplementing that, there probably will be more support given to local industries through tax breaks or subsidies, etc., to help boost domestic manufacturing in some of these economies as well. So that's going to be part of the response, I think. It's also worth bearing in mind that there's going to be lots of places that don't respond. And I think, again, it comes back to the geopolitics. If you are a big trade partner with China, you're reliant on China, it's not in your interest to try and respond to cheap Chinese imports.
Yeah.
So, some of the commodity producers in Africa, Latin America, Russia itself are probably just happy to take on cheap Chinese imports. It helps to rein in domestic inflation. Yeah. So the response is I think, going to vary depending on your view of the geopolitics.
Sure, yeah. And Dr. Rumki, taking that thought forward in terms of the China flooding the market with cheap product, vis-a-vis the 90-day pause for India, and if that really happens, or if that is there to happen, how do we soften that impact? And how do we use the Make in India initiative much stronger to get our cost embedded in such a way that we still have an ability to export more product?
Right. So as I mentioned, it's time India needs to realize that we have to be more competitive. And as I mentioned earlier, it's time that India should look into what are the areas where India can innovate and scale up better. Like some of the sectors definitely do benefit.
Yes.
Like if you look at sectors, say for example, the defense sector. I mean, to be very honest, last week we saw the investments that the country has made in the defense actually saved India from the hundreds of drones and missiles that we were attacked out.
Sure.
And these have been the investments for decades together.
Yeah.
There might have been questions as in why we are investing, but last week we proved that these investments are required. Last week we were against some of the Turkish missiles.
Sure.
10 years later we will be up against even far more advanced technologies.
Certainly.
How do we even save ourselves there? And that is where I think we need to know that we have to up our game.
Yeah.
Many of these surface-to-air missile defense systems that we saw were indigenously built. Yeah. So we're proud of that. But the fact that if we can collaborate with US, the Indo-US collaborations or the Quad collaborations, all this will actually help India up its game in defense.
Yeah.
And even in space. So that is one sector where I think India should up its game and be more competitive. The second I would say is probably the electronics and IT. Now,
Yes.
if you look at the share of exports, a decade back, traditional goods, say textile, the diamond stones,
Yeah.
and agriculture products.
Spices.
Spices. These were around 60-70% of our exports.
Yeah. Sure.
And the electronics, electricals, pharmaceuticals were barely 20%. From there on, we are now around 32% of exports, these high-end manufacturing products. So we're clearly moving up the value chain, and this has to accelerate. And with these tariffs coming down, or with these collaborations with other countries, I think these sectors will definitely benefit. If you look in March, Apple's exports to the US went up from 81% to all by 96-97%.
Sure.
Correct? And even Apple announced that they will be supplying more from India.
From India.
Correct? So those are the sectors which will definitely should move up the value chain. Textile. I mean, we had quite a bit of a concern as to where textile would be, because it's one of the labor intensive and creates a lot of employment. Some few situations in the last year helped the textile sector. And after the tariff, I think India was very happy. It's like, think of a child who has got 10 out of 100, but then his friends have got 5 out of 100. So he's happy. So in our case in textile, what happened was we are competing with Bangladesh and Vietnam. They have got higher differential tariffs. So we were happy that we might be able to compete better.
Sure.
But the fact that in this game, we need to be making sure that in the long run, we sustain. And that's where we really need to improve our logistics cost. We have to bring our cost of production, make ease of doing business better.
Yeah.
Some of the policies should help in ensuring that technology is adopted faster and sooner.
Sure.
We are skilled better so that we can adopt technology to our advantage. So I think these are some of the measures India should definitely look into to improve.
Excellent, excellent. I'll reach out to our delegates. Anyone has any question, comment? We have mics that we can take. Yes, Tendulkar Sahab. Because of your surname, I'm giving you first preference.
I think what is grossly missing is the VET, vocational education training. China has got 5 lakh vocational education, we do not have even 1,000. So something which make a difference. Whether it's a tariff or non-tariff, when the scale, trade can only make money if there's a scale.
Sure.
India cannot match the scale. One Apple cannot give the scale. Just to tell you, in 80s, the place where we are sitting is called Siebes. India was the largest exporter of the motherboards and things to the
Securities. Yeah.
That era yet to come back now, because I don't know what happened. Another example is IT. IT, even down the line in a place like Gadchiroli, there's an IT professional.
Yes.
Can this happen now? Then this will be IT is one of the largest exporters. Garment is another. Pharma is third. All 3 industries did percolate down the line to at a taluka level. If this happens, India will be top of the world, and that is not too far now. It's nearby.
Thank you so much.
I'll just weigh in. In case of pharma, I think we have really done well,
100%.
especially in generics.
Yeah.
If we
and
have
API bulk.
Exactly. But I think with this change in tariff regime, I think pharma sector might see some impact,
Some
because just a week back, Trump announced that they will be reducing the prices of the prescribed products by 50%, and that kind of gives a very direct competition to the generics market that we have. So clearly there are headwinds. Again, in the IT, I think there are some opportunities coming up. Say, if manufacturing picks up in the US, there will be servicification of manufacturing which will go up.
Sure.
And India is probably ahead in that game, right? And if I look at that proportion, we are just probably 1 or 2% of that segment, servicification of manufacturing. Can we not tap into that? That is something which we need to look at. And all these collaborations that we are doing with UK or the US, these are the opportunities that we should definitely look into and tap into when we do these agreements.
Thank you. Yes, Gupta Sahib.
Yeah, hello. Thanks. See, India has world's best IITs and IIMs, okay? See, government has already made a plan because Mr. Tendulkar has said that in equivalent to IITs and IIMs, we will have the skill universities, okay, world's best skill universities. And you will see this impact very soon. We have planned for more than 40 million skilled workers, which will not only develop Indian manufacturing, but it will be exported all over the world. You will see the blueprint in near future.
Thank you so much. I like that. And if you look at the growth that we had, right? I mean, regardless of what Tendulkarji said, right? The growth doesn't come on the back of certain things which don't happen, right? There is always something that keeps on churning at the back. There is always some development takes place. The labor, the skill sets, they don't wipe out, right? They don't lose. There are some new skill sets come up. So certain things go into oblivion, certain new things come in. Not everything is transparent in the first 3, 4, 5 years. It takes a while for the ecosystem to build and give the result to you. And if we had not had done certain things right in the last 10 years, we wouldn't have been at number 4. We could have gone down from 12 to 14 to 16. And I bet you in 5 years, as Dr. Rumki said, the defense sector has so much of budget and power, and we have seen what happens when you have power. We will make our own Rafale, and I know this is a big statement. If this government was there, and this is not a political talk, 20 years back, we would have manufactured our own Rafale than importing it, for sure, right? Amit Shah said that 3 years back, and that is going to be our dream today. And this has come through all the taxpayers' money. For once, I felt like, I have contributed to my country in the last 10 days, bigger than any part of my life, any time in my life, right? So, thank you so much, Gupta Sahib. We are coming to the end of it, but is decoupling, Shilan, between US and China is the answer? Because the answer is no, I know. One of your slides says that US exports with China and US exports with non-China, if I combine those lines, they're above 70-75%. So it is not in US interest to decouple with China in any which way. There will be certain partnerships that will need to go through. There will be much more tariff control. What do you think?
Yeah, I think it's very reasonable at this point, given all the uncertainty, to think that there may be some reconciliation between the US and China. I mean, there's some evidence of that even as recently as on Monday when this trade deal or talks of reducing tariffs vis-a-vis each other was announced. So it could be something that happens. But I think if we were to see any kind of move towards some sort of truce, it's going to be quite narrow, probably just focused on keeping tariffs where they are now with this reprieve, rather than a sort of fundamental reset in relations between the US and China, because of the geopolitical rivalry, which predates Trump. It predates anything to in the past sort of 7 or 8 years, and it goes way back beyond that. There is a huge amount of suspicion and hawkishness towards China from within the US and across the political spectrum as well. So I think it's feasible that Trump comes out and claims to or casts himself as this great deal maker. But I think that fundamentally the factors that have driven a wedge between the US and China would ultimately come back over time, because of this superpower rivalry, which runs much deeper than bilateral trade or worries about the exchange rate, for example. And the flip side of that is, we've outlined this view of the world where the US is allied with the likes of India, but also Japan, Australia, and in particular Europe. There probably is a bigger risk, I think, rather than of a China-US reconciliation. The bigger risk is that we see a split in alliances between the US and Europe. I mean, some of the rhetoric towards Europe from within the Trump administration has been so strong, very, very critical of its defense policy, for example, obviously threatening tariffs on the EU. So that might be something that I think is the bigger risk, and in which case trade would then fracture across those lines as well. So the flow of investment, trade, technology between Europe and US could be held back. That's obviously negative for the global economy and for Europe in particular. But fundamentally, there is still more that brings Europe and the US together rather than splits them apart. So I think when we're looking at this in 5 years' time, it's still likely that we have these two very distinct blocks, one led by the US and one led by China.
All right. We have only 20 seconds. So quick thought, very little crisp comment about current tariffs. Chilan, what do you think? Quick one, really.
Current tariffs.
Yes. What happens to
where
India?
do I start?
Yeah, quick
I've
one.
only got 10 seconds.
Yeah.
No, like I said, I think that what we do know is that, so Trump's in the mood for deal making. He wants to cast himself as the deal maker. We've had the US-UK trade deal. India is apparently very close to front of the line. I think that countries that are able to even secure limited trade deals with the US will probably face a lower reciprocal tariff. But there is a 10% universal tariff, which the US is using as a revenue generator for their fiscal. And that's going to remain in place.
Perfect. Dr. Rumki?
What I believe is India will face definitely some competition in exports in the US. And let's be prepared for that. If India can quickly come into an agreement with the US, which it will, given the pace at which it is working, I think India will benefit. It will have strong collaborations with the US in certain high-tech industries and will probably ensure that we also emerge as the +1 in the Asia. And I think this has been a good lesson for India as well, to understand that at the end of the day, we cannot depend on certain geographies. And we need to diversify. So yeah, be self-more.